Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So far 9 problems I have completed on valuation of goodwill. Now in this video 10th, 11th, 12th, 14th. So 4 more problems I am going to complete, that is 10th to 13th problem. So these 4 problems I am going to explain you in this video. So if you want the perfect command on this topic, watch all the videos from beginning till end, don't skip in between. If you have not watched the earlier videos, I suggest you go to the playlist of my channel, select the subject Advanced Accounting New. Watch the videos on goodwill theory, be perfect about the concept, then you can understand the problems. Every problem will have some peculiar new points, so focus on those new points. So apart from this advanced accounting, I have uploaded so many subjects videos like financial accounting, cost accounting, management accounting, corporate accounting, income tax, statistics. Then for MBA also I have uploaded the videos for investment management, financial management, etc. So many videos are there. So visit the playlist, select your subject, watch the video and enhance your knowledge. Now, before starting the 10th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Take the screenshot of the points, then I'll explain every point in detail. Now, see the 10th problem. Given below is the balance sheet of ABC Company Limited as of 31st December 2005. The particulars: equity and liability, shareholders fund, share capital 2 lakh, reserves and surplus 150, non-current liability, long-term borrowings 1 lakh, current liability, trade payables and short-term provisions. Assets: non-current assets, fixed assets, tangible, intangible asset. An intangible asset consists of goodwill. Non-current investments, other non-current assets. Then current assets are inventory, trade receivable, cash and cash equivalent. This is the complete balance sheet given. Now notes to accounts: share capital 20,000, equity shares of 10 each, reserves and surplus, general reserve. In profit and loss account we have opening balance 12,000, current year profit 48,000. Remember, total 60,000. So current year profit is given 48,000. Then long-term borrowings 8% debentures, trade payable consists of creditors, short-term provision consists of provision for taxation, tangible assets consist of land and building, plant and machinery, and long-term investments consist of nothing is given, so we assume it is a non-trade investment. Other non-current asset, preliminary expenses. These are the fictitious asset, imaginary asset. We should not consider while calculating capital employed. Next page. Profit for the year included 6,000 income from investment. Investments are all in government securities. In the previous theory video, I have explained you. While calculating capital employed, 3 assets we should not take. Goodwill we should not take. Non-trade investments. Example of non-trade investments are government security. We should not take. In our problem it is given long-term investment consists of government security. We should not take. And any income arising on that government security should also not be considered. And lastly, fictitious asset like preliminary expenses should not be considered. Then land and building are worth 2 lakh and plant and machinery 40,000. These are the present value of land and building and plant and machinery. So don't take the balance sheet value, take the present value. Compute the value of goodwill on the basis of 3 years purchase of super profit. So first we need to calculate super profit, then multiply super profit with 3 years to get goodwill. Normal rate of return on capital employed in this type of business is 10%, NRR. That's all. So for calculating goodwill according to super profit, we need super profit. Super profit is FMP minus NP, future maintainable profit minus normal profit. For calculating normal profit, we require capital employed. The first task is to find out the capital employed. Now for capital employed, take all the assets. Land and building present value 2 lakh given in the last paragraph. Plant and machinery present value 40,000. And no present values are given for current assets. So as it is, we'll take. So inventory is 1 lakh, trade receivable 1,20,000, cash and cash equivalent 40,000. Total of the assets are 5 lakh. Minus outside liabilities. Outside liability consists of long-term liability, non-current liability, that is debentures. Debentures 1 lakh, creditor 60,000, provision for taxation 40,000. These are called outside liabilities. Deduct outside liability, will get capital employed 3 lakh. That's all. Now we need average capital employed because current year profit is given. So half of the current year profit we deduct from capital employed to get average capital employed. How much profit for the current year? It is given in the balance sheet 48,000. The profit for the current year 48,000. And last paragraph it is saying that profit includes 6,000 rupees income from investment. When we are not taking investment, we should not take the income from investment. The income from investment will be deducted from current year profit. The trading profit will be 42,000, right? Now capital employed at the end of the year is 3 lakh. From 3 lakh, deduct half of the profit earned during the year. During the year 42,000. Half of 42,000 is 21,000. So deduct 21,000. We'll get average capital employed 2,79,000. Now, we need to calculate normal profit. Normal profit is equal to average capital employed into NRR, normal rate of return, which is given in the last line of the problem. So, average capital employed into NRR. So, 2,79,000 into 10%, 27,900 normal profit we got. Secondly, we need the FMP, future maintainable profit. Actually, FMP consists of past average profit adjusted for future changes. But we are not given the past profits. So whatever current year profit is there, that itself we take it as FMP. Whatever we have earned during the current year, the same profit we are going to get in future also. We are going to earn in future also. So FMP, since past year's profits are not given, so we take current year profit as FMP. How much is current year profit? 42,000. So FMP 42,000. Super profit, FMP minus NP. So 42,000 minus 27,900. We'll get 14,100 super profit. Goodwill is equal to super profit into number of years of purchase. In the problem it is given 3 years of purchase of super profit. So multiply by 3. 42,300 is the goodwill. That's it. This is the end of problem number 10. Now, 11th problem I am reading out. See carefully. X company limited is to be absorbed by Z company limited. So one company is being wound up and another company is taking over. So Z limited will take over X limited. In order to determine the purchase consideration, goodwill was agreed to be taken at 3 years purchase of average annual super profit. The profits being averaged over 5 years. So we have to calculate goodwill according to super profit method, taking 3 years purchase of super profit. So super profit into 3, you will get goodwill. So how to calculate super profit? By averaging the past 5 years profit. The profit of X company limited for the last 5 years before charging income tax at 50% are respectively 3,80,000, 350, 550, 490, 430 for each of the above 5 years. Profits are fluctuating, so we take the simple average. But this profit is before income tax of 50%, but we need the profit after income tax. 2 of the directors of X company limited will be appointed to the board of directors of Z company limited at a remuneration of 40,000 each per annum. In the past, no charge was made against profits of X limited for the services of directors concerned. So earlier, the old company was X limited. 2 directors of X limited are going to become directors of Z company limited after takeover. And the 2 directors should be paid remuneration at the rate of 40,000 each. So 40,000 into 2, 80,000 is the director's remuneration which is payable in future. So what we calculate? First we calculate average profit of the last 5 years. From average profit we subtract the remuneration payable to directors. To that profit, we charge tax at 50%. After deducting tax, we will get the profit, average profit. Then the average capital invested in the net tangible assets over the period is 11 lakh. We are not required to calculate capital employed because directly it is given average capital invested means average capital employed, that is given 11 lakh. The normal return to be expected from the particular type of business carried on by X company limited is 10%. NRR. NRR 10%. Average capital employed 11 lakh. So 11 lakh into 10%, 1,10,000 is the normal profit. Calculate goodwill of X company limited based on the above information. That's it. So simple. So average capital invested is 11 lakh. Normal rate of return 10%. So normal profit 11 lakh into 10%, 1,10,000. That's it. Now we need FMP. So average profit of last 5 years. Because the profits are fluctuating, we take the simple average. Add up all the profits divided by 5. If you add up all the profits, you are getting 22 lakh divided by 5. 4,40,000 is the average profit. So take the average profit. From average profit, the remuneration payable in future. 2 directors are paid remuneration, each 40,000. So 40,000 into 2, 80,000. So 4,40,000 minus 80,000, 3,60,000 is the profit before tax. To that, income tax is payable 50%. That is given in the problem. So income tax 50%. 50% of 3,60,000 is 1,80,000. Deduct 1,80,000. Profit after tax is 1,80,000. Now 1,80,000 is the FMP. Past average profit adjusted for future changes. That is 1,80,000 FMP. Super profit. FMP minus NP. 1,80,000 minus 1,10,000. 70,000 super profit. Now we need to calculate goodwill. Super profit into number of years of purchase. In the problem it is given 3 years of purchase. So 70,000 into 3. You will get 2,10,000 is the value of goodwill. That's all. So every problem you can see some points are different points. So focus on that. Now 12th problem. From the following, calculate the value of goodwill at 4 years purchase of super profit. A's financial position is as follows. Sundry assets, current liabilities. Average net profit of the last 4 years. Average capital employed. See here, when average capital employed is given, we don't require assets and liabilities. Actually, assets and liabilities are required only to calculate capital employed. When once capital employed is given, what is the need of assets and liability? We don't require. Now, average capital employed 9 lakh, average partners average annual remuneration 18,000. In future, partners have to be paid remuneration 18,000. This will be deducted from the average profit. Then the expected rate of return is 10%, NRR. So average capital employed is 9 lakh and NRR is 10%. NRR is 10%. So 9 lakh into 10%, 90,000. You can see here. Normal profit is equal to average capital employed into NRR. Average capital employed 9 lakh, NRR 10%. So normal profit 90,000. Now we need FMP. Average past profits. The average net profit is given in the problem as 1,20,500. 1,20,500 is the average profit. From that, the expected remuneration to be paid in future, that is 18,000. Deduct 18,000. So 1,02,500 is the FMP. So we got FMP, we got NP. So super profit is equal to FMP minus NP. So 1,02,500 minus 90,000, 12,500 is the super profit. Now goodwill, super profit into number of years of purchase. It is given 4 years purchase. 4-year purchase. So 12,500 into 4 goodwill is 50,000. That's all. This is the end of 12th problem. Now I am going to read out the 13th problem. See carefully. Hammer Limited and Grace Limited propose to amalgamate. That means merger. Two companies are merging. Before balance sheet of Hammer Limited and Grace Limited as on 31st December 2005. So here two columns are given, Hammer Limited and Grace Limited. Balance sheet complete given. Shareholders, share capital, reserves and surplus, non-current liabilities are not there. Current liabilities are 1,50,000. Then assets, fixed assets, tangible assets are given, non-current investments. Now non-current investments are given for Hammer Limited. There is no non-current investment for Grace. But non-current investment should not be taken while calculating capital employed, assuming that it is non-trade investment. Then current assets 4 lakh and 2 lakh total. Balance sheet given. Notes to account, share capital, general reserve, reserves and surplus, general reserve, P&L account. Now net profit after taxation. For calculating FMP, we are given the net profit of the past 3 years, 2003, 2004, 2005. The profits are fluctuating, so we take the simple average. 1,30,000, 125, 150. Here 45, 40, 56. The fluctuating profit. Goodwill for the purpose of amalgamation may be taken as 4-year purchase of average super profit trading on the basis of 15% normal profit on closing capital employed. Remember, it is not asking you to calculate average capital. It is asking you to calculate the closing capital. The 15% on closing capital. The current assets of Hammer Limited are to be taken at 4,20,000 and the Grace Limited 2,10,000. The present value of Hammer Limited and Grace Limited given. Ascertain the value of goodwill. That's it. So we have to compute the value of the goodwill for two companies, Hammer Limited and Grace Limited. First of all, I am going to find out the capital employed. Fixed assets 4 lakh, 1 lakh. That is given in the problem. Current assets present value are given in the last paragraph. The present value of current assets are 4,20,000, 2,10,000. Total 8,20,000, 3,10,000. Minus outside liabilities, current liabilities are 1,50,000. Only one current liability. Then capital employed 7,20,000, 2,60,000. This is the closing capital employed. And in the problem it is specifically given that normal profit should be calculated on closing capital, not on average capital. So that's why we are taking closing. Normal profit is equal to capital employed into NRR. The normal rate of return is 15%. So capital employed 7,20,000 into 15%, 1,08,000 is the normal profit of Hammer. Similarly, normal profit of Grace, 2,60,000 into 15%, 39,000. So we got the normal profit of both the companies. Now I am going to calculate FMP, future maintainable profit. Calculating average profit. 3 years profits are given for Hammer and Grace. So I have taken the total of 3 years profit and divided by 3. So 4,05,000 divided by 3, 1,35,000 is the average profit of Hammer. Similarly, 1,41,000 divided by 3, you will get 47,000 average profit of Grace. But this profit consists of income from investment. So that income from investment should be deducted. How much you can see here investments, non-current investments. Here it is given the non-current investments are earning a return of 6%. Actually, one point is missing there. Non-current investments. In non-current investments, it is earning a rate of return of 6%. There is a misprint there. You write on non-current investments at the rate of 6%. In the problem, non-current investment at the rate of 6%. So 6% of 1 lakh is 6,000. So subtract 6,000. So 135 minus 6, 1,29,000 is the FMP of Hammer Limited. Similarly, there is no investment, no income from investment for Grace. So same 47,000. We got normal profit and we got FMP. So FMP minus NP, we will get the super profit. So here super profit, Hammer Grace, FMP 129.47 and normal profit 1,08,000, 39,000. Subtract, you will get 21,000 and 8,000 are the super profits. Now goodwill is equal to super profit into number of years of purchase. Number of years are given 4 years. 4 years purchase. So goodwill is equal to 21,000 into 4, 84,000. For Grace Limited, 8,000 super profit into 4, 32,000. That's all. This is the goodwill for Hammer Limited and Grace Limited. So far I have completed 13 problems on valuation of goodwill. Each and every point I have explained you in detail. So if you are following continuously all the problems, all the videos, definitely you will get a lot of confidence on this topic of valuation of goodwill. So if you are satisfied, give a like to the video, share my channel, give your comment, subscribe, and